Good morning, everybody. Welcome to the Prosperity Through Multifamily Real Estate Investing podcast. I am your host, Real Estate Cody, and with me, as always, the coffee connoisseur himself, Mr. Brian Alfaro. How you doing, bud?
Good morning, Cody. Nice to see you. Glad to be joining the show again today. Looking forward to our guests.
I know. I'm looking forward to it as well. And we just wrapped up another great conversation. So, just fired up and just great conversation. So, in that regard, tell us who we're speaking with today.
All right. Today, we're going to have the pleasure of speaking to Mr. Venkat Avasarala. Venkat is a seasoned real estate professional. His main focus is ground up development of market rate multifamily properties and acquiring value add workforce housing multifamily properties in landlord friendly Sunbelt states. Venkat is developing 1,500 multifamily units in DFW, Austin, Phoenix, and I'm sure some other markets too we can definitely talk about. Venkat also acquired 3,600 existing apartment units since 2016. He is managing $105 million in investor equity and has over $450 million in assets under management. Venkat, welcome to the show.
Thanks for having me, guys.
Yeah, I appreciate you being on. And Venkat, sounds like it's been kind of a slow couple of years for you.
Yeah, you can say that. COVID has gave us all of us a tremendous opportunity. Just before COVID, everything was just teetering down, settling down, mellowing down. But then again, COVID came and just threw a wrecking ball at us, at our economy and all that, and just created this huge opportunity for all us to get involved.
Yeah, man, absolutely. And I think we're in a great opportunistic environment right now where there's a lot of wealth being created in real estate, especially the multifamily space right now. So happy to get into that conversation. But before we do, man, tell us a little bit more about your background and I guess how you got your start in the commercial real estate space.
Sure. So I'm originally from India, came to United States in 2002 on a student visa, went to University of Huntsville, Alabama, the Rocket City. And I chose that university because of the high-tech nature of all the industry around the university. And ended up doing my master's in electrical engineering over there. And after that, I ended up in IT because IT was taking off after the dot-com bust and everything. I mean, by 2004, it's really taking off. So I ended up working in IT away from my electrical engineering focus. And worked for several Fortune 500 companies. My last couple of jobs was with PepsiCo and Bank of America. I spent 14 years in IT. Gave up my job with Bank of America when summer of 2018. So that is actually when I started doing this full time. But my real estate experience started around 2007, just before the Great Recession. I started buying some single family homes. Again, the only idea was to generate some passive income. I tried stocks. I'm not good at it. I'm letting the greed and the fear making me decisions, and I'm making a little bit money, losing some money, but at the end of the year, when I do the taxes, it's always a loss. And sometimes more than the $3,000 that you're allowed to take deduction for, right? So I said that, look, I mean, this is not working. Maybe I was not mature enough at the time. At the time, I was like, 24, 25, too young. And it's just stocks are not for us. So that is why I went into real estate and acquired about 20 single family homes, all with my money, all the way until 2015. And that is when I saw that these, and we were spoiled, right? The people who bought these single family homes. I mean, I wouldn't write an offer until I see a 15% cash flow on day one, right? I mean, that was the thing. I mean, that was the conditions back then. People now, if they can cash flow $1, people are happy, right? But back then, if it wouldn't cash flow 15%, I wouldn't even write an offer. So anyway, I ended up buying those 20 homes, and I ran out of my fanny spots. And there's not great deals, which could continue to give me that 12, 15% on day one. So I figured that, I had to make a switch. And I looked into several other things, right? The laundromats, the dry cleaning services, the 7-Elevens and all that, just to continue to, make some passive income. But none of these things have anything to do with passiveness. It's like another job. And I have a well-paying job, and it's a very demanding job. I just don't have the time to run around running a 7-Eleven or anything like that. So that is when I came back to real estate and went into multifamily. The reason I did not choose multifamily automatically is because I know that it's bigger properties, bigger check sizes. I need to raise money, and I was very reluctant to raise money. It's something just didn't appeal to me when I'm getting started. So that is why I tried to see if there is anything I can do just with my money. But when I came back to multifamily in 2016 is when I syndicated my first property. And ended up B and C class. And I ended up buying about 3,500 units, give or take a few, and had 12 cycles, full cycles, and annualized return of 23% to the LPs, net of fees. So I did all that, but then again, it was good. That business plan was working well in Dallas, and Phoenix, Colorado. This is where I was buying. I'm still buying in Phoenix and Colorado, but I'm completely stopped those operations in Texas. I'm not doing any value adds in Texas anymore. But if I can find an off-market deal, I'm still doing those in the western states of Arizona and Colorado. And then got involved in ground-up development and land development from early 2000. Aligned myself with some very experienced partners because I don't have any experience in development, right? So you got to work with somebody who does. Because we cannot be learning on investors' dime. So that is just exactly what I did. And developing about 1,500 units in Dallas, Austin, and Phoenix. And did a couple of land development projects. So that is where I take these, I buy raw land and just take it through cities and then get the zoning, keep the multifamily piece that I want to build upon, and then sell everything else. So these are a few things that I'm doing.
You said there's a few things that you're doing, man. That's a lot. Look, that's an incredible resume for sure. And I mean, putting this in retrospect, 2015, 2016, that's a pretty short window, man. So that's impressive. So kudos, for the successes so far. And I like listening to your story. I like how you've kind of nomadically transitioned to different opportunities that you saw that were, really taking off, even at your background, right? And, you transitioned from engineering background to IT, and then, single family, then multifamily, now ground up development. So I love the transition of just really finding where the opportunities lie. Absolutely. And making pivots where it makes sense. And so, yeah. And then it sounds like you're in all the right markets: Dallas, Phoenix, Colorado. I'm sure you've been a very happy investor in those markets.
Absolutely. Yeah, I stick with these high growth markets. And about pivoting, guys, like, some people who does value add, they just don't look at construction. And the people who do construction doesn't do value add. But my philosophy about this is, even if you look at stocks, right? Nobody says that I'm always a value investor, right? Always a tech investor, always growth stock investor. They just move their the investment dollars to whatever is performing or expected to perform well. So you cycle. Nothing is static in this world, and real estate is not an exception. Before COVID, we could buy a relatively new product, right? 2005, 2010 built product at a discount to construction cost. Then why would we build? But after COVID, now there's no discount whatsoever. There's a huge premium. And all the projects that I'm doing, they have a good $50,000, $60,000, $70,000, $80,000 margin, even in Texas. And Phoenix Properties has like $100,000 plus margin to your cost of building. Of course, we have to build, right? So whatever generates that margin for us and our investors and help us hit the IRRs. So that is what I do. Like in 5 years from now, but let's say if there is no margins and IRRs in development, we'll do whatever gives us those. So we have to constantly look out what's happening, where these billionaires are putting their money, where are the top movers of the market is doing. And we have to pay attention to the market and try to follow the market.
Yeah, I think we would 100% agree, right, Brian? And I think this is also a conversation that we've been having, on all fronts and in all interactions that we're having, is just, the idea of the value add play is really, it's been overplayed. And
absolutely,
to some degree, it's almost dead, right? Where everything, like you said, is a premium. And so looking at it on a risk adjusted basis, you have to start making more sound investing decisions. And you said it so eloquently earlier, is you don't want to be taking risk on your investors' behalf. You have to protect that interest. And so looking at this on a risk adjusted basis is where you really need to make a decision. So I don't know, Brian, what do you think? I mean, again, in all the conversations we've been having about the value add play and seeing the way the market's been moving, what do you think about this transition to, things like development and such?
No, I think Venkat is doing exactly what he should be doing if he's a good fiduciary of his investors' capital, right? It's just finding that yield, finding those opportunities that make sense. And I also like that he said I had no experience in something, so I went and found somebody who did, right? So we always say it's not how, it's who. So you got to build those relationships in your market, even if you're, going through some cycles and multifamily super hot value add. Well, it doesn't mean don't be building relationships with developers. I'm sure he didn't just pick up the phone and say, hey, I want to develop, let's go. He had some relationships going, right? So, but staying flexible is, I think, super important in today's market cycle because things are moving very fast. 18, 24 months ago, you could have bought a property and probably be selling it right now and 2x your investors' money. But that's not going to always be the case. So you have to stay flexible. You have to stay adaptable. And also, I like that he's offering different vehicles for his investors. Some might come to him and say, hey, I want stable. I want to park my money for 5 years. Cool. Let's buy some multifamily. If somebody says, hey, I want to park my money for 24 months or less, let's do some ground up development where it's a little bit quicker of a churn in your, for the investors that are more IRR sensitive. So I think being flexible and heading in that direction is a great move for Venkat. Makes a lot of sense.
Yeah. Yeah. So Venkat, I want to kind of go down this road here of talking about development here because, there's a lot of opportunity here and we've had a previous guest on our show that was a developer as well. It's been, that was about a year and a half ago or so. And his comment was like, look, as a ground up developer, I capture all the initial upside. You guys buying existing, you're buying somebody else's upside. And that was kind of an aha moment for me. I was like, it's a really great point. But, I want to get your perspective on the landscape of development right now, because as we've talked about where existing multifamily is trading at a premium, everything's being hyperinflated. You're also experiencing some of that on the development side, right? Your input costs are higher. There's been supply chain interruptions. Talk to us a little bit about, how you've been navigating your business model through the post-COVID world, so to speak.
Absolutely. So yeah, we definitely have this supply chain issues. Lumber, everybody knows, right? What's going on with the lumber. Our previous president added about a 20%. I don't know why. I don't know which lobby made him do that. I would assume that US lumber lobby probably made him do that. But they slapped a 20% tariff on it and they reduced it to 10. Then this new administration came, they took it back to the 20% level. There's a tariff. They're our biggest trading partner right next to us from Canada importing lumber. And then there are wildfires which are happening, everybody trying to catch up for the lost time in 2020. All these things are contributing to sky high prices on construction material. There is labor scarcity. Our net immigration has been zero since the previous administration has taken over. So we don't have people to come build for us. So yes, it is not easy at all. But as a developer, I will not sell my property unless I have the margin on it. Of course, the rents have to support. As long as the rents are growing, we still underwrite to a decent IRR on the construction. And the person who buys it from us, they have to make sure that they keep the rents or go from there. So all I'm saying is that all these challenges that we are facing in the construction, they will all be passed on to the next buyer of our property, and the buyer will pass it on to the people. So finally it has to fit the inflation table. So that is what it has to happen. But if you think about it, right, as a developer, how I am creating, so I wear two hats, developer hat, and I also do value add today. I still do that, but I just don't do it in state of Texas. I do that in Invest. In a few minutes, I'll tell you why. But as a developer, I am creating value by bringing this building out of the ground, right? That's the ultimate value add if you think about it, adding value to dirt, right? So I am creating value, I'm forcing the value, and also, just sweat equity and all that. But when you see, if you go buy a Class A property and try to, and if you're underwriting a 15, 16, 18 deal level IRR, there's a lot of optimism built into it. So you're just assuming so many things, and you're really assuming that the market will carry you, right? In order to create that kind of value. So that is why I like development, in spite of all the headaches dealing with cities and all that. And also one other thing about multifamily is about 5 years back, 10 years back, you have a 10-acre corner site. You go to city and ask them to spot zone it for you multifamily. They say, sure, go for it. Now they're not doing that anymore. Especially in Texas, what they're saying is, if you want 10 acres of multifamily, you need 100-acre or 150-acre parcel. Go put a mixed use PD on it and bring it to me. And yes, I'll give you your 10 acres, but you would do a single family, a townhome. It's to motivate people to create housing. And they don't want a spot zone anymore. And I'm talking about small cities with like 40, 50,000 population. I'm not even talking about large cities. Nobody wants that. So they don't even like us, like multifamily, because high density, they have their issues, right? I mean, we have a lot of kids, right? In multifamily, every small unit has 2 kids in it. And these kids have to be educated. And it costs in state of Texas on average of $10,000 to $12,000 per year to educate them. And we pay taxes, what, 2,000 to 3,000? So these cities, they lose money on this multifamily. What they really like is single family, they break even, but you need single family consumers around it so that you can put office, retail, and all this next door where there's no kids to educate. They're just profit centers, right? So multifamily, they actually lose money. Single family is where they break even. Retail, office, and these other stuff is where they make money, right? So they have to still balance their books. So that's why what's going to happen in the future is the multifamily land, already it's happening, but it'll become more scarce and more scarce. You can no longer buy something for like $10,000 a unit because land cost is a fraction, always has been. But now it'll be like a third, right? I mean, that's the future is going to be. So that brings challenges and opportunities is all I can say. But when you do buy something existing, let's say Class A property, there is no moat around it. Everybody can do it, right? And they're just bidding up to these 2 caps, 3 caps. I mean, it's just, I don't know where it's going to stop, right? But if you pull back and do construction, still a lot of people do it, but like a fraction of the value add people, right? So you do something which is hard to do it. And we have to do it just because it's hard, so that you can add more value to it and less competition, if that makes sense.
Yeah, that does, Venkat, and that's a great articulation. And I'm surprised to hear you mention this about the municipalities in their outlook on the multifamily space or the restrictions on multifamily, from a cost basis, because this is the first I've ever heard that, where the municipalities are losing money when they're zoning for a multifamily product. That's interesting. And it kind of makes sense looking at the supply and demand imbalance that we have existing across the entire United States. A lot of the municipalities have very tight restrictions on development projects and such. And it's kind of the big question mark is really why? Why would they be so restrictive and not allowing more development to come in, knowing that there's such a critical housing shortage? But if it truly is a monetary incentive, then that does make sense.
And that's only true for in Texas. And I'll tell you why. We do not have state income tax, right? So somebody got to pay for these fire stations, especially schools, right? A lion's share of these property taxes go to schools. That is how they collect taxes. So our property taxes is like in top 3 in the country, exorbitantly high. And also, to make it worse, the state government has delegated the responsibility for the local municipalities to set their own thing. So one influential person in a municipality can just, if he's swinging very liberal, you might jack up your interest tax rates. You see what I'm saying? So it's not centralized. So it's a mess. Our property taxes are exorbitantly high. There is no protection for you as a commercial real estate. I have one property in 2021. The tax value went up to 62%. It raised from year over year. And this happened in my 3rd year of ownership. It's not even the first initial tax adjustment I'm talking about. They can do whatever they want. So obviously we sued. And guess what? My court date is in March of 2023. The funny thing is I already sold the property, I already paid the taxes last year. And this is 2022. And I'm trying to get them to hear me. And now I have to wait till March 2023. How is this business friendliness? So Huffines is this gentleman's name. So this guy has a lot of Chevy dealerships and all that. And he's actually running against Abbott for the upcoming governor elections. And he's running on that. I'm going to abolish this property taxes. This is just draconian. So that is our weakness. And also you may not know that. And we have something called a Robin Hood law in state of Texas. What that means is, so most of our population is concentrated in Houston, Austin, Dallas, and San Antonio, right? Just 4 metros. But Texas is so big with so many counties onto the east, west. So in some counties, maybe 1,000 people live, and they just don't generate enough tax dollars to send their kids to the school. So guess how that will get funded. So what Robin Hood law does is it asks all these ISDs to retain $6,500 per kid that they educate in their local schools, keep that money, and just send the rest to us, right? So Plano, where I live in, has just wired $190 million for the year of 2021, which over and above the $6,500 limit that they're allowed to keep. You see what I'm saying? So you cannot keep, just because you collected money, you cannot keep. You have to send anything after 6,500 back so that they can go redistribute that money elsewhere. And the funny thing is, Plano is actually short of money to just cover. In Plano, I mean, it's an expensive location. You cannot educate a kid for $6,500. So guess what they do? They go into debt of $20 million just for the year of 2021. So that's the reality of our property tax situation here. It's a huge mess. So that is the reason why I don't do value add in state of Texas anymore, because these taxes, and especially insurance, I mean, it's now they're talking about 3% deductibles, 5% deductibles, 1,000 new unit dollar cost. If your expenses are not predictable and stay low, how do we project cash flow? And how is the cash flow durable? So that's why I ran into mountains, and in Phoenix and Colorado, those are the places where my expense ratios are 30%, break-even occupancies are 50%, compared to 60% expense ratios in Texas and 85 to 90% break-even occupancies in Texas. I'm after COVID, you need that safety margin, right? So that's why I'm doing those value adds over there and ground-up construction over here.
That's a whole bunch of nuggets right there, Venkat. I tell you, because it is a real problem. You're absolutely right. I mean, insurance and property taxes, it is a massive headache for investment real estate owners and just real estate owners in general. I mean, homeowners and whatnot. It is a massive, massive problem. And Brian, I know we get this all the time where we have out-of-state investors coming into the market, and you look at some of their assumptions and whatnot, and we're like, hey man, like you're way off here. You got to be careful. And they're really, it's an eye-opening moment for them to just really understand the implication behind, our taxes and our insurance burdens that we face. So you're saying, well, part of your motivation then is to like you said, develop here in Texas, is you're kind of mitigating some of those, burdens, so to speak, by coming up.
It's easy to develop here relatively, right? Because the cities are easy to work with. See, I'm actually doing another project in Mesa, which is suburb of Phoenix. And my partner there is an architect, and he's a member of City of Mesa's P&Z. He's on the board. He's a voting member. Can't get it out of city. Stuck there for 8-9 months now. The CDs, I'm talking about just the construction documents here. It's hard. It's not as easy as Texas to get a property through zoning and construction documents approval process. It's not. So here you can build 3 properties in the same time as it would take to, get one property out of the city system. So it's not easy. So there is genuine scarcity because for whatsoever reason, some cities just are not so pro-development. In Phoenix's case, what happened is they oversupplied in 2008, and they crashed 55%. So an average home value went down by 55%. So that trauma still weighs upon them, and they're really careful when they give these permits away. And same thing with Colorado, slightly different reason. They had a decent crash too, not to the extent of Phoenix, but a lot of, liberalism, you can call it. There was this one city, I like it. It's called Lakewood, which is just right west of Denver. So Lakewood is wedged between Denver to the east and mountains to the west. So landlocked, and there is 6,000 federal jobs there, the highest concentration of federal jobs outside Washington, D.C. Guess what? The voters got together in July of 2019 with Lakewood Growth Initiative. And what they did under that is they restricted development to add more than 1% of inventory per year. Applies to both single family and multifamily. The name of the initiative is growth, but it's an oxymoron because what it is doing is restricting the development. And I like that because it's like Bitcoin. They cannot just generate how much our housing I want. So I want to buy there and hang on to it because there's not a supply coming. And the area is very good because somebody can live in Lakewood, go to work in Denver, and go to mountains in like 15 minutes, right? Hiking and all that. Denver is all about lifestyle, right? And the pay is very high. Even if you make a $100,000, you cannot afford a home there. You have to make like 200, 250, a decent home, right? Because home values are like 600K and above. So it's a rent versus buy scenario. It's a 50% discount to rent than buy. So what does this do? So this lets me attract the best tenant possible who I don't have to chase to collect rent, will take care of the property well, and then stay there longer because Denver houses ain't getting cheaper anytime soon. And also there is no supply risk because the city is stopping the supply there. And it's decently, I wouldn't call it tenant friendly or landlord friendly. I was able to evict people and all that, no issues or anything like that. So that is where my expenses are low, income is high, lower expense ratios, lower break-even occupancies, and more importantly, predictable expenses. So that's why I do hold the properties in the Western states and also proximity to California, especially for Phoenix. It's true that a good number of Californians come to Texas, but not all of them are coming to Texas. The very first thing Californians who are moving out of these LA, San Francisco, what they will do is see where they can resettle in the same state. So they're moving to Riverside, right? The Inland Empire area. They're going to Sacramento. And then people are saying that, look, I'm done with this state. Now they look, where can I settle around the West? So is that Phoenix? Is that Las Vegas? And is it Colorado? And then they come to Texas. Not all of them are taking a beeline. Now, technology is a little different, right? I mean, if you are in the tech, you cannot go to Phoenix. You have to come to Austin or Dallas, right? So if you have a tech job, then sure, yes, they are taking beeline to Austin and Phoenix, but majority of the population is either resettling inside the state or just outside the state, but they're not all coming to Texas, right? So that there is that aspect. Constant supply of well-educated tenants with good salaries porting their jobs into all these other places. How else you explain Las Vegas, even today, their rent growth is just amazing, 10, 12, 15% rent growth, but unemployment is one of the highest in the country, 7.5% to 8%. How do you explain that? Because people are choosing to move there and bringing their jobs over. So it's a long-winded answer, but yeah, that is the rationale behind doing value add in the West and ground up construction in the Texas.
Yeah, well, I think it goes back to, like you said, your background and just core investing principles is where you find opportunity and you invest in opportunity that makes sense, right? And you got to go where the opportunities lie. And every market's different, as you just so eloquently alluded to. Like Colorado's very different than Texas. Phoenix is very different than Texas. And so I think it's important to, at a rudimentary level, just understand the dynamics of the market you're in and make sure that your investing strategy is in line with what the market's giving you.
And play to the strengths. See, every market has strengths and weaknesses. Come up with a business plan for that metro where you play off the strengths and avoid the weaknesses to the best of your ability.
Sure.
That is what I'm doing.
Yeah, no, absolutely. I completely agree with that. Brian, thoughts?
No, I love this. I think the strategy is really important. Understanding whether you're an active or a passive investor, understanding the market economics, and then what is the market giving me is kind of how I look at it. And just take what the market is giving you. Don't try to apply some, I'm going to be the new guy trying to create this crazy strategy, first time kind of thing. The market's giving you something in particular. Take what the market's giving you, enjoy the benefits of it, understand, and try to avoid as much of the losses as you possibly can. But there's going to be pros and cons with every market, as you so eloquently alluded to. So we just got to make sure you understand the fundamentals of that market. And, before you go in and try to apply some business strategy, like we were talking about, Cody, with investors coming into Texas, All they hear is how attractive Texas is, but they don't understand the taxes. They don't understand the market economics. They don't understand the city regulations and things of those nature. So just know where you're investing is, I think, a great point to highlight.
Absolutely. All right, Venkat, let's make a pivot here because I want to get more into this development topic here, and I think right now it's relevant to what we're seeing as far as investor expectations, because everybody knows, especially your sophisticated investors, yields are getting tighter and tighter, right? I mean, it's just harder and harder to get any type of margin at the premiums that we're buying. And so we're seeing, I don't know, Brian, I don't know that we're seeing a shift, but we're seeing more of a sensitivity to an IR basis versus a cash flow basis, right? And so development kind of falls right in line with that, because you're not really producing any cash flow through the development cycle, but you're really capturing a lot of that. You're really creating that initial upside, which is providing that equity and appreciation after the development cycle. So let's talk a little bit about that. Talk to us about kind of the development timeline and how it's able to generate that particular return that an investor would be attracted to.
Cool. Yeah. So here's the thing. Most of my investors are accredited. I'm sure yours too. I refuse to believe that they need that 4%, 6% cash flow to make ends meet. I just don't believe in that. They're accredited. They have a ton of money in the bank. I mean, they're good with their money. That's why they are able to accumulate that money to give me in the first place. So, but this cash flow thing, depreciation, not paying taxes, this whole thing has been oversold, especially by these gurus, right? I mean, who sell prosperity in droves. And they were, even the gurus, I mean, they were made look very good by the market. You cannot do anything wrong in the last 10 years, right? From 2012 all the way to 2019, even past now. If you buy before COVID and all that, no matter where you buy, what you buy, and how you operate it, you are a winner. You cannot lose in the most cases, right? 99% of the cases. So what happened is that it lets these investing houses and all that sell this idea that, you cannot pay taxes, you need to this depreciation and then this cash flow, you live off this cash flow and all that, which was true for a while, right? I mean, there were some properties where I was sending 12, 13% net of fees, quarterly distribution. I mean, it was just amazing. And that happened in Texas only because the CAD somehow magically missed. It didn't catch the sale for like 2 years. Right? So that lets me, excuse me, enjoy that crazy cash flow. But the moment they caught him, I mean, it went back to where it's supposed to, like in state of Texas, right? So I refuse to believe it. Now, the second aspect is, now I started hearing people saying that, look, we got to lower our investors' expectations. I mean, we cannot hit that 18 IRRs, maybe 12, maybe 13. Maybe we cannot do 8%. We can give it as a pref and let it accumulate, but maybe we'll send them 4%. So then I said that, look, inflation is at 7% now, right? And that's just government figures. And we know that in reality, it's much more than that. So why are we lowering investors' expectations? Shouldn't we work on projects which actually pay them more, right? Because we were paying them that 18 IRRs and all that when inflation was 2. Now it's 7. So technically it should be like, much higher than that. Why are we trying to do reverse? So that is when I figured my value add days are numbered here. And that is what forced me to pivot to go create that IRR. And my benchmark IRR that I set for myself, again, I try to empathize and put myself in LP shoes. Okay, what do I expect, right? Is 21 IRR. I want to hit that for net of fees to investors. And for now, I don't know how long this will last, but for now, the ground up construction and the land development projects are allowing me to do that. And so that is what I do. And also what I do is that, definitely, no doubt about it, right? Construction, unless you know what you're doing, can be very risky. One small thing, if you don't catch it for too long and suddenly can come back and bite you and might shut down the project and might cause huge losses and all that. So what I do is, even the way I structure my ground up development deals, I give them, my investors, a 10 pref, not 6, not 7, not 9. It's all accrued, but it's a 10 pref. And after that, I give them a very generous split of 80-20, even after the pref, inclusive of pref. So and I do that until they reach the 21 IRR. If there is anything left after that, it will be stuck to GP, but that's a 21 IRR. So my thought process here is if the deal underperforms or performs the way you underwrite, and or it overperforms, whichever way the case, investor is taken care of, right? Because we as GPs, we do so many projects. We make money on this project, we don't make money, it's okay, it evens out. It really is not a big deal. But for an investor who has a $100,000 check, I mean, he chose to invest with me on that particular project. And if that project, if doesn't perform, then that's for him, it's 100% risk. He's not in all my deals, he's in that deal. So it better perform for him, whether it performs for me or not. So that's the thought process behind putting in. And last night I did a webinar and I needed, it's a 350 unit project that I'm doing in Salina. And as a tranche one, I raised money in two halves. I don't need all the money up front. I need some money to buy the land and do the pre-construction activities. So I was doing a tranche 10 and it got oversubscribed. People saw what I'm trying to do and why I'm trying to do it. And it got oversubscribed by the time it ended, the webinar ended. So people are, I mean, that's a word of confidence, right? Investors are saying, you know, what you're saying makes sense. The way you're structuring deals makes sense. I mean, that's a word saying that I'm doing the right thing.
Yeah, that's always a great feeling when you can be oversubscribed and have that investor confidence. And, you know, like I said, I think investors are getting more and more sophisticated, you know, especially those who've been in the industry now for several years. I mean, they're watching and staying attuned to what the market is giving us, what it's producing, where the market's going. And again, looking on a risk adjusted basis, I think, you know, it's pretty widely understood that right now you can't go buy that 60s, 70s product at a 3.5 cap and expect to make that 20% IR without there being a high level of risk. And so I think more and more investors are moving more towards a little bit more of a risk adverse model right now. They're looking for a little bit more security because the big question mark is, hey, everything's great right now. This year may be equally as great as last year, but what happens in 2023? What happens in 2024? I think everybody's kind of speculating. So
you don't even have to wait that far now because yesterday FOMC meeting happened, the Feds met and they did not spell it out, but they are indicating a rate hike, 4 of them this year, starting with March. Mm-hmm. So now what will happen is cap rates have to expand, man. I just don't believe that people arguing that the cap rates won't expand when the interest rates goes up. It just doesn't make any sense. I cannot pay you a 3.5 cap when my interest rate goes up from 3.5 to 4.5. You see what I'm saying? I cannot buy an upside down project. At least on the 60s, 70s C and B class properties, we will see some cap rate expansion. And it starts in March.
Yeah, it's a interesting conversation there because I think, like you said, there's, you know, some of the fundamentalists that would definitely support that thesis, and then, you know, you have others that say, man, there's just with the amount of liquidity and demand for this product, it's, you know, interest rates may rise, but then, you know, people are still going to be buying.
Probably, right? Class A, because again, for now, there is the scarcity. At some point, this will level out maybe in 2, 3, 4, 5 years somewhere where we have enough product where there is no such thing as scarcity. Because if you think about it, what is concept of Texas? Texas is big, everything big in Texas. Everything is affordable in Texas. There's no scarcity for anything. That is what we were. But suddenly after COVID, there is genuine scarcity for the first time, at least since 2006, since I've been living in the state of Texas. At some point, this will level out. Mm-hmm. So that scarcity standpoint, I mean, it might help you with this class A where people continue to, you know, buy these 3.5 cap properties, even with the raising interest rates. But it's really tough to do that in B and C. This is what's going to happen. Okay. So Texas, we talked about taxes. We talked about insurance. And then the big thing that we have to talk about is this upkeep. Texas weather is not kind on these properties. Let's start with the ground. Ours is a clay soil. It expands and contracts all the time. And what happens is it creates these pipe separations of the sewer pipes and all that, foundation issues and all that. And then we have a lot of humidity that creates mold. That gives you a perfect opportunity for mold, and then wind damage, hail and that thing, this thing and all that. What I'm saying is it costs you so much money of CapEx, even after you executed your business plan, you upgraded all those units and all that. Just the upkeep of the property, especially 60s, 70s property, is very expensive. But then again, your rents, and that tenant is one who's struggling. Not everybody is doing well in this country. The people who could accumulate their money, invest in real estate, crypto, the stocks, they did really well and they feel wealthy. And that's why there is this demand for luxury goods and everything, right? But on the other end of the spectrum, they got, it's like a wrecking ball to their life, right? They had these nice jobs, they're going in service industry and all that, but suddenly this COVID came along and wrecked them. And federal government did a very decent job in helping them out for now, but that assistance will not go forever, right? So, and also the income inequality, all that is getting worse. So now you have this B and C class product where you're buying at a 3.5 cap. The tenant is not doing well. And I'm a big believer that if my clientele is not doing well in life, I will not do well either. I mean, that's simple common sense. So you have this product where it's hard to hang on to it because of all this upkeep. And now at some point, they can't pay the rent. I mean, you'll have delinquency issues and all that once the government assistance stops. And now you just bought it for 3.5 cap. And the last nail on the coffin is the interest rates going up on you. So you are trapped. You can't get out. You're out of funds. You have to do a cash call. Just imagine, just play it out.
So going back to your point, like you said, going down the path of development, you're mitigating those risks of being a long-term holder of these assets because you're not having to deal with those headaches. Now, just so I can clarify, is your strategy from the development piece is to get through the development life cycle, and then dispose as soon as you're going into lease up, or are you actually
my strategy is to buy zoned land. Now I'm doing my own zoning also, but then again, it takes a little bit of time, but I'm very interested to acquire zoned pieces of land and develop it and wait exactly 1 year and 1 day from the CO date, certificate of occupancy, so that I qualify, me and my investors will qualify for long-term tax rate, and then sell and then run. Don't walk, run. That is my strategy, because the taxes and insurance will get you if you stay in there. And that is not a big deal for an institution who only expects 10 to 12% IRR over a 10-year period. But for you and me in a syndication fashion, it won't work out. We cannot make it work at a 10 to 12 IRR, especially in state of Texas. So that's my strategy. So 3.5 years, 6 months to do the plans, right? To get my CDs approved. And then 18 to 21 months, depending on the size of the project, to build, and 9 months to complete the lease up. And the lease up phase and the construction phase overlap because you don't deliver all the buildings at once, right? So sure. As the buildings get delivered, you start leasing up. And from the date of the last CO, from the date of the CO of the last building, I got to wait 1 year and 1 day and then sell. So 3.5 years period is what I'm looking at.
So from an investor's perspective, then, what is the life cycle or investment cycle timeline? Are we looking at a total of, let's call it 36 months, a 3-year, timeline, or
42 months?
42 months. Okay. Yeah. Got it. Excellent. And like you said,
no cash flow and no depreciation. And I'm very upfront about it. If you drank that Kool-Aid a lot, and if you cannot shake that out of your head, that, that you absolutely need to have the cash flow, the 3% or 4% cash flow and the depreciation, this is not for you. Because even when we start leasing and operating, of course, we have to depreciate, but I'm not going to go get myself a cost seg study and all that, because next year I'm going to sell it. So I'm going to just take the regular depreciation. So this is not from a good investment from a depreciation standpoint. And also I set an expectation that I'm going to send you zero cash flow in that year 3 when I am operating. If I have anything, the company, I have to pay you the pref, right? I mean, it's in the company agreement, but managing expectations is very important when you deal with properties in Texas, especially for cash flow.
Yeah. Well, and look, there's a different investor appetite for for a variety of different products. And like you said, this investment strategy is not going to be for everybody, but for those who are, this is a great opportunity. And I agree with your point about, I mean, Brian, we see this every single day, right? Where we're looking at this product that's becoming available, the market rate deals that are coming out, and it's just like it's hard to scratch your head and justify paying whatever amount per door, knowing that Venkat's over here building it for the same. So it's yeah, it's an interesting market cycle for sure. I don't know, Brian, what do you think?
It's definitely interesting, and I love what he's doing. He's he's still value adding, but he's doing a different value add, right? So he's just ground up development, and I think investors, it's very attractive, and people that have that appetite, it's the perfect vehicle for them.
Yep.
And land, folks, I mean, it's a huge opportunity that we have. Didn't have this much of a commotion when it comes to land before COVID, but then again, suddenly we need all these housing and multifamily and all that. And there's not just enough land. It's just like toilet paper analogy, right? What happened after COVID? Immediately after COVID, toilet paper, which is supposed to sell at 30 cents a roll, went for like $5, $20, right? Why did it happen? Because everybody wanted those toilet papers right then and there. And we are a very efficient economy. We don't keep extra stock around just so that somebody wants this toilet paper, right? So we are always just in time kind of a supply chain system, right? So same thing for houses, right? If everybody wants to build house right now, and everybody wants his own land to either build single family or multifamily, obviously the prices will shoot up. And that is what I want to capitalize and provide that investment opportunity for my investors, where I can go buy like a 50 acres or 100 acres, take it through city, chop it up into pieces, replat them, and then sell paper lots. I won't even cut the blade of grass on it. It's just, I took it through zoning. That is my value add. And developer will worry about putting utilities in the ground and all that. That's his take. But I squeeze the lemon gently and get 50% of the juice out. And then I hand this wedge of lemon to the next guy. And now he has to squeeze it hard to get the remaining 50%. I'm happy with my 50% because I barely squeezed anything. No. So that's another land play that we gotta do. And I'm telling you, the returns are like much better than our value adds and all that.
Brian, I think we're squeezing the lemon too hard, man. I think we might need to we might need to consider our strategy here. No, but hey, Venkat, this has been great, man. I think, listen, again, I think there's a lot of opportunity. I think the development space makes a lot of sense right now. And I think there's a lot of interested investors, like you said, are looking for more of a downside risk. And yes, there's risk that does come along with development. I think you articulated that well, but overall, I think, there's definitely some opportunity here versus what we're seeing on the existing side. And this is something that investors really need to pay close attention to is, what is the best way to hedge against your downside risk right now in this environment? And it's tough to do. Like you said, especially looking at the value add space, it's really hard to find those opportunities right now that make a lot of sense. So appreciate you giving us some insight here into the development world. I wish we had more time, man, because I think we barely scratched the surface.
I can talk all day. I'm very passionate about it.
Well, I tell you what, man, what we may have to do is have you back on the show and just continue the conversation. But, we're kind of wrapping up here. Brian, before we get to the final four, any other thoughts for Venkat?
No, it's been a great conversation. I definitely picked up a lot of golden nuggets, and instead of buying buildings now, I want to go buy a bunch of land. So
yeah, I was gonna say, Venkat, just tell us where we need to invest. Okay. Just send us to the investor portal and we'll go there.
Right.
But, well, cool, man. Well, listen, we got a few more questions for you before we wrap up, and then we'll wrap it up here. But what do you like to do for your continued education to further your investing?
So right now I'm picking my mentors, and I don't pay them. Those are, for me right now, in where I'm doing and what I'm doing in DFW, that's Jerry Jones, owner of Cowboys, but because he's a prolific land investor. Medad Moyadi, very big land developer. And then Sam Zell, with whom I copied his whole investment thesis about Class A. And he builds them and operates them. I just build them and sell them. But the premise is, I learned a lot from him. And then finally, there's this huge land broker called Rex Glendenning. So these are my four mentors. I just watch them like a hawk, exactly what they're doing and all that. So that is my continued learning. I'm doing exactly what they're doing.
That makes complete sense. I love that. What are you looking forward to most in 2022 in the multifamily space?
Well, I just want to complete and get several more ground up construction projects going, because I don't think, just like anything in life, right, it won't last forever. This scarcity in Texas that we are talking about is very rare one. Nothing is scarce in Texas. Never have been. But now it is genuinely scarce. I'm convinced. So we're going to have the scarcity for next 2, 3, 4, 5 years tops, right? So I want to make most out of it, and I want my investors to make most out of it. So that's why I'm striking some quality connections with very experienced developers, and I get to co-develop these projects with them. So I'm trying to start as many opportunities as possible. This way I can not only do all these things, but scale, right? And not run out of daylight in the day.
Mm-hmm. All right, Venkat, what advice would you give to the audience to help them further their businesses?
Be very careful on whose advice you're taking. There's a lot of advice, some free, some paid. I took not so great advice for quite some time. I could have done even a lot better, but then again, I realized, but especially if the advice is being given to like 400 people at one time, maybe it's not worth anything, right? Because you cannot create prosperity in droves for masses. So I picked my mentors on what I'm trying to do. And in Phoenix market, I'm trying to pick my mentors there. And again, they don't know me. I know them, but they don't know me. I don't pay them, but I'm watching them, what they're doing, because these are all the big boys which have very big research wings, and they get the best advice possible. So I just copy their moves.
Nice, man. Great advice there. That's really solid advice there for sure. All right, man. Tell the listeners how they can learn more about you and get connected with you.
Absolutely. Yeah, well, they can visit my website, Stryker, Stryker, properties.com, or they can email me at Venkat, Venkat, at Stryker, Stryker, prop, not properties, prop.com. They can call me at 281-727-9238.
Awesome. Well, Venkat, appreciate you tuning in with us today, man. Great conversation. Looking forward to staying connected.
Thanks, Venkat.
Perfect. Thanks, guys.